Again, I use the analogy of Uber and a yellow taxi. You know, again, if I'd come to work this morning in a yellow taxi or if I'd come in Uber, what's the difference between the two companies? They both took me in a car. They both technically are travel companies. But I think we'll both agree that the one is really an old world car company, taxi company, and the other one is a technology company. Well, in simple terms, what's the difference between us, a REIT, and a syndication? Well, the most important thing is about alignment and how the fee structure is put into place, because ultimately that determines the difference. So if you look at a pure broker, when a broker sells you a house or a building, they make a transaction fee up front. So you are trying to buy a good building, they are making a fee. They are incentivized to sell you something, and you are trying to get a good investment to run for the long term. If you look at syndication, it's exactly the same thing. They generally make anywhere from 15 to 25% on the front end. So you invest $100, they take $25 off the front end. You're technically broke before you even get started. They are incentivized on the front end to make their money, and you are trying to make money. You're not aligned, okay? And what's really interesting is that people invest for the long term, but the syndicator is incentivized just to do as many deals as they possibly can. And if you look at a fund or a REIT, they make their money primarily by assets under management. They even have an acronym for it, AUM. And if you go to a fund manager or a REIT party, the way that they shake hands and high-five each other is how much AUM they have under management, because that's how they make money. They don't make money by the performance of the assets. They make money by how much is under management, and it can range from about 1.5% to 2.5%. But now you as an investor are making money based on the performance of the investment, not on how much money they've got under management. The other thing that's really important with a fund or a REIT is that there's more than a 70% correlation between them and the stock market. So therefore you think you're investing in real estate, but you're actually not. You're investing in a financial instrument which is tracked by the same sentiment as the stock market. So when the stock market crashes, your REIT will go down in value with more than a 70% correlation. And therefore, why do wealthy people invest in direct property? Because it's asymmetric to the stock market and it pays an income no matter what happens in the financial industry. All that we're doing is helping people invest in direct property like the wealthy top 1% do, using technology so that it's far more efficient, far more cost effective, and most importantly, providing you with a service which is trustworthy, transparent, we're all aligned in the process, and most importantly, we're making it accessible to everyone. You could say that a yellow taxi and Uber is the same thing. You could say that a REIT and what we do is the same thing. I believe fundamentally they're different. Technology is enhancing our lives.